Everybody talks about using life insurance to do the infinite banking concept. But what if I told you you can do the concept of infinite banking without life insurance at all? My name is Devin Burr. In this video today, I'm going to show you exactly how you can practice IBC, the infinite banking concept, without using a specially designed and engineered whole life insurance policy. You're going to get a ton of value from this. And when you do, share the video. If you have not subscribed to my channel, make sure you do that. Throw your questions in the comment section and hit the bell, hit the like, all the things that you guys always hear. Appreciate you. Let's jump into it. So here's the thing. Infinite banking is a concept. It is not a product. And that is why you can do the infinite banking concept with something other than a whole life insurance policy. It just happens to be that a whole life insurance policy, if structured correctly, is the best product to use. At the end of this video, I'm going to share with you exactly why that is, but also I'm going to share with you other things you can use to practice the concept in your life. So if infinite banking is a concept, what is the concept? It's simply mimicking what banks do with money. It's very simple. Banks collect deposits, right? Those deposits go into the bank. The more deposits the bank has, the more money they have control over. All they have to do is just pay a percentage to you for holding your money. It's very, very low, but let's just, for easy math, say that they pay you 1% for holding your money. That means their cost to control your money is 1%. Because they have to pay you 1%, that's money leaving them. That means that the deposits are actually a liability to the bank. So what do? They turn those deposits into an asset by lending them. They simply take your money at a cost, 1%, and lend it to someone else for more than what it costs them. They make a spread, an arbitrage on your money. So if they lend it out at 5%, someone is paying that loan back at 5%. They only had to pay you 1, but they made 5. So that's a 4% spread, basically a 400% cash on cash return that the bank is making with your money. As soon as it comes back into the bank, what do? They lend it out again. Let's say at 8%. Now they're making a 7% spread, which is a 700% cash on cash return. Money comes back into the bank immediately lends it out again. They understand the velocity of money. The more they use the money over and over and over again, they only got to pay you 1%. As long as they keep taking it and making more than what they're paying you, they're making a spread on money, which is your money, by simply controlling it. That's all infinite banking is taking back that control. Instead of you depositing your money into a bank so they can take it and do what I just explained, you're mimicking what they do with something else. The best product is a specially designed and engineered whole life. But again, you can do the concept with other things. Let's jump into those other things and the pros and cons behind them. One example of something you can use the infinite banking concept with outside of whole life insurance policies is an equity line of credit on your house, a HELOC. Remember, what the bank is doing is they're using deposits, basically just a pile of money at a cost, to go make more than what it costs them to control the money. So an equity line of credit on your house, that's the pile of money, okay? You can control that money at a cost, just like banks do, by simply paying the bank to control the money. So let's say you got an equity line of credit on your house and you can borrow at, let's say, 10% to keep math easy. So you borrow at 10%, let's say 50,000 bucks. You're now controlling that 50 grand for 10%. You take it and you put it into, let's say, a flip on a property. You make a 25% return on that flip. What you've just done is made a 15% spread by using the bank's money. You're just simply controlling that money at a cost to make more than what it costs you to do. You're just going to simply take that money and feed it back to the equity line. Remember, just like the bank does, when the money comes back to the bank, they lend it out again. So you're turning loans into an asset, just like banks do. This is a loan. You're getting that money, 50,000 bucks. Loans don't have any taxes. So you're controlling that 50 grand for 10% interest. And then you're just simply taking it and making more than what it cost you to control it. You've made a spread on money, just like banks do. You put that money back into the equity line of credit, and then you have another opportunity that comes up to turn another loan into an asset, just like banks do. Let's say you take a loan again at 10% to pay off a credit card. The credit card is 20%. So now all you're doing is you're paying off the 20% loan with a loan that you're controlling money for at 10%. All you'd have to do is simply take what those payments were on the credit card, because those payments include 20% interest. You take those payments and you pay them back into the equity line. So what's happening is you're paying down your equity line of credit that's at 10% with payments that were to a credit card at 20%. You're making that spread just like banks do. So the concept can be used with an equity line of credit. What are the pros and cons, though, to using a home equity line of credit to do this? First, pros are it's simple interest. Simple interest means you're only paying interest on the balance. So if you're practicing infinite banking, if you're constantly flowing money back into the source, the equity line of credit, you're constantly paying down the balance. Therefore, you're paying less interest. Very beneficial. Another pro is that you have different options with your payments. A lot of times on an equity line of credit, they'll give you an option of an interest-only payment. So you got a smaller payment you can make, which gives you basically a bigger upside for your spread, a bigger upside for your arbitrage. So that's definitely a pro. Also, easy access. A lot of times with an equity line of credit, you can just get a checkbook. So you can simply just write a check, so you're able to access those funds relatively quickly. What are the cons, though? The cons, first off, is there is risk involved. Let's say you deploy the money into a real estate deal, and that real estate deal goes sideways. You don't have any money coming back from that investment. You still have a payment on that equity line of credit that you have to make. Even if it's only interest only, it's still a payment. So you could potentially be losing money there because your investment isn't panning out the way you thought it would. Also, there's variable rates. That means that the rate can change month to month. It could change annually, what have you. And with the market, it tends to change a lot. So the rate could be very high. It could be very low if we saw rates like we did from like 2010 to 2021. The rates can be very, very low. So you can make a big spread on money, but that can change really, really quickly because equity lines of credit are variable interest rates most of the time. You can get them fixed in, but then you have a higher interest rate to fix it in. Also, market changes can definitely be a con, meaning if the housing market drops and your equity in your house goes away, guess what? So does your equity line of credit. Now you can't use those funds anymore to practice the infinite banking concept. A couple other things that can be used would be either a personal or business line of credit, even credit cards, personal or business. Now, if you use business, cool thing is you're keeping your personal credit out of the equation and keeping the risk of your credit going bad. So that is definitely a pro to using business lines of credit. Again, even personal or business credit cards. All you're simply doing with infinite banking is you're using a pool of money. So the credit line can be that pool of money at a cost to go make more than what it cost you. So these aren't the best because they're generally higher interest. If you got a personal credit card or a business credit card, you might have an introductory rate of 0%. So then at that time, those are really good to use because there's 0% interest And if you go make even 10, 15% of a return, you're really actually getting a lot for that. The risk though is that you have to make a payment. So if again, your investment, just like with the equity line, if the investment that you're deploying the money into when you're practicing infinite banking is not making a return, you still have to make a payment on the equity line of credit, whether it's business or personal. If it's personal, you might have your personal credit really go down in the tank. So you don't want to really risk that. There are some pros and cons to it, but those two things can be used to practice the concept. Again, you're just accessing a pool of money. The line of credit is the pool of money at a cost, deploying it to make more than what it costs you. Since it's a little higher interest, it might be tougher to actually make a return with them. As you make that return, you just pay down the line of credit, use it again, just like banks do. You could also use a HYSA, a high yield savings account. The pros to this is they are very easy and accessible. Anybody can get one. Not like an equity line of credit where you got to qualify for it with your credit score, all those kinds of things. Anyone can just get a high yield savings account. So very accessible. The cons though is that when you use that money, when you use the funds to go practice the infinite banking concept, you're no longer compounding the money because you're only getting growth based on what's inside of that account. So if you deploy some of the funds, you're no longer getting growth off of those funds. So that's definitely a con. Also, rates change very, very quickly and often. I remember when my high yield savings account that I had with American Express was about 4%. And then it went all the way down to 0.4%. It's back up to about 3.7 now, but those change and fluctuate, I think, monthly. So if you're only earning 0.4% on the money that's actually sitting in the account, that's not a lot of growth. So that's definitely a con. But again, you could practice the concept. You just have a pile of funds there that's very easy and accessible. Anybody can use it and start deploying it into different opportunities. A real estate deal, paying off a credit card, buying a vehicle, what have you. You can practice the concept of infinite banking using a high yield savings account. The list goes on and on. You could use a brokerage account. A brokerage account, so if you've got a whole bunch of funds in the stock market, let's say, the pros are you can borrow from that at a relatively low interest rate, let's say around 4 to 8%. So that's your control cost. Again, remember what banks do. They control our money at a cost, what they pay us. They just take it, lend the money for more than that control cost. So you're doing the same thing. You're able to control the money from the brokerage account at around 4 to 8%. You're borrowing against your brokerage account. That's a benefit because you still get uninterrupted compounding, uninterrupted compound interest. So that means your money inside the brokerage account is still compounding and growing at whatever it's doing in the stock market while you're using it at the same time to go practice the concept of infinite banking. So what does that mean? You can double dip. You can make whatever it's making inside of the brokerage account and also go make money outside of the brokerage account at the exact same time. So that's definitely a pro. Cons though, there are risks of margin calls. That happens. It can happen often. So that is definitely a con if you have a risk of that happening with your brokerage account. Also, another con is there's no tax advantages. If you have growth inside of your account, inside of your brokerage account, there's taxation on that. You're gonna have to pay taxes. Most likely it's gonna be long-term capital gains. So there's no advantages there when it comes to the taxation. Also, there's no guarantee that this brokerage account is gonna go up in value. So it could lose value, meaning you've got less money that you can access and borrow against in order to deploy it into infinite banking. So as you guys can see, the infinite banking concept can be used with other products because it's just a way of moving money, mimicking what banks do. However, a whole life insurance policy that's structured properly is the best product to use. I'll prove it to you guys here by comparing the other ones that I gave you guys. When it comes to liquidity, being able to access those funds, that varies when it comes to these other products. With whole life, your liquidity is guaranteed. If you have cash value, the insurance company has to let you borrow it. You are the first person in line to be able to use those funds. Basically, the insurance company, when they take in premiums, they have to deploy those premiums in order to make money so that they can pay death claims when someone dies. You're one of the places that they make money because you have to pay them an interest rate. So remember, it's a control cost. If you're borrowing from an insurance policy, you're borrowing the insurance company's money at a cost. That cost is helping them become more profitable, and that's how they're able to pay the death claims. Here's the thing though, as the owner of a whole life insurance policy, you outrank anything else that they can deploy the money into. So if you have cash value, you're guaranteed to be able to use it. It doesn't matter what it's for. Compounding, compound growth. With these other methods, these other products, only some of them are going to compound. Like the high yield savings account, it does not compound and grow if you use funds in order to use the infinite banking concept, or I should say deploy it for the infinite banking concept. And what it's going to compound at, these other things, that's not guaranteed. So again, if you have a brokerage account, that brokerage account could go down in value. So you're not getting the compound growth. When it comes to a policy, you get guaranteed compound interest that'll never go down, guaranteed, plus dividends. Dividends aren't guaranteed. However, the companies that we use have paid dividends every single year for over 140 years consecutively. So they're not guaranteed, but they're basically a sure thing. Insurance companies know how to make money. When they're profitable, you get a dividend because it's a mutually owned company. You're a part owner of the insurance company. So when they're profitable, you're profitable. It's a beautiful thing. Risk. With these other methods, the risk is high. I went over that with you guys. With a life insurance policy, specifically a whole life insurance policy that's structured correctly, the risk is extremely low. You can never lose money inside of a policy because it's guaranteed to grow. It'll never go down in value. So the risk is almost non-existent. Death benefit. These other things do not leave a death benefit for your family. Whole life, it gives you a guaranteed death benefit to your family. So it's a built-in legacy. You can make sure that your family gets wealthier and wealthier and wealthier, and it's tax-free. Death benefits get paid to your family with no income tax. Beautiful thing. Tax advantages. These other things do not give tax advantages aside from when you borrow against them, loans aren't taxed. So that's the only advantage. But they don't grow tax-free. They don't even grow tax-deferred generally. So with a life insurance policy, a whole life insurance policy, you get a ton of tax advantages. You get tax-free access, so loans are not taxed. You get tax-free growth, 100% tax-free growth, and your family gets a tax-free death benefit when you pass away. It is a guaranteed event. It's gonna happen. We just don't know when. And then control. With these other things, you have partial control. You don't have full control. With a life insurance policy, a whole life insurance policy, you have 100% unhindered control. And what I mean by that is these are the things. Let's say you borrow against equity line of credit on your house or a business line of credit. You borrow against those, you have to make a payment. You have to do that. That adds to the risk like I went over with you guys. With a life insurance contract, you don't have to make a payment. You decide to make a payment. You're in full control. The reason you do not have to make a payment is because when you're borrowing from the insurance company, they're basically giving you an advance of your future death benefit. So they know you're going to pass away at some point. They just don't know when. So if you never pay back the policy loans, they'll just simply deduct it from your future death benefit because you used it while you were alive. that gives you full control over the money. 100% full unhindered control. While infinite banking is a concept, not a product, as you can see, a specially designed and engineered whole life is just the best product to use for the concept because of all the things I listed. If you are ready to take back control of your money and stop giving it to the banks so they can control your money and go make a ton of money with it, if you want to mimic what banks do, if you want to take back that control, check out the link in the description. My team and I will set up everything for you. We will do a consultation call for you at no cost. We'll set up the policy at no cost. The way we make money is once you fund your policy, the insurance company pays us for bringing them business. We will then show you how to implement the concept of infinite banking, how to use your policy to start mimicking the bank. And that way you can become your own bank. I hope you got value from this video. Until next time, love you guys. Peace.